Hey, it's Joe, and this is the final installment in the Quant Trading and Futures video series. Today we'll be recapping everything we've discussed throughout the series. So from beginning to end, we really have covered a lot throughout this video series, and we're going to end by going through each presentation and devoting one slide to the most important points, the biggest takeaways from each one. Alright, so to begin, intro to futures. What is a future? Yes, technically, it's the obligation to buy or sell a specified asset at a specified price at a specified date in the future. But traders don't really think about it that way. It's better to think about futures as a method of controlling an asset without putting up the full capital amount. We talked about the futures spot parity equation and that it's priced via no arbitrage argument, meaning that if this equation doesn't hold, there's a risk-free profit available. So in practice, it always holds. There's built-in leverage to futures, inherent to futures. Because of that, we only have to put up a small amount of capital relative to the amount we're controlling. We end up with a lot of idle cash. We can invest that cash at the risk-free rate and capture that. There's no leverage constraint with futures. There's no short selling constraint with futures. Now, there are only about 50 actively traded futures markets. That is one downside of trading futures. There's a lot more actively traded stocks. And finally, we discussed creating a continuous time series, which is important if you're trying to backtest a futures trading strategy. There's two different ways to do this, the spliced method and the back adjusted method. The spliced method, the price levels are correct, but the price changes can be wrong. And for back adjusted, the price levels are wrong, but the price changes are correct. And most of the time when you're doing a back test, you're going to be using both the spliced and the back adjusted. After we introduced futures, we introduced quant trading. What is quant trading? That is trading using a systematic set of trading rules, followed without discretion, and supported by data. There's two ways you could trade, systematically with quant trading or discretionarily. Some benefits of systematic quant trading are that it is a scientific, testable, and emotionless approach to trading. Quant trading's central assumption is that patterns in financial markets that have existed in the past will continue to exist in the future. You need this assumption. If you don't have it, then it's theoretically impossible to make any money quant trading. And key to quant trading is the backtest. What is backtesting? That is the process of evaluating a trading strategy by testing it out on historical data. Of course, you need to be very careful that you're doing this the proper way. The first step of backtesting is to come up with the trading rules. The trading strategy rules should be simple rather than overly complex, and they need to make sense economically or psychologically. They shouldn't be generated from some algorithm. If an algorithm generates the trading rules, it's likely to be overfit if the strategy doesn't make any intuitive sense. Once you've come up with the strategy rules, you backtest it by recording the strategy's daily P&L, both without and with transaction costs. Without, in order to see if there's any edge there at all, and with, to see if the edge persists after accounting for these transaction costs. And then we went through a whole bunch of examples of quant trading strategies. We broke them up into 5 categories: momentum, mean reversion, statistical arbitrage, term structure, and alternative data. Momentum strategies operate under the assumption that if the market's been rising, it will continue to rise. If the market's been falling, it will continue to fall. Mean reversion's assumption is the exact opposite. It says if the market's been rising, it will reverse and begin to fall. If the market's been falling, it will reverse and begin to rise. Next, we have statistical arbitrage, or stat arb. This is when you're trading multiple different markets against each other in a market-neutral fashion. You're trying to profit from relative mispricings rather than absolute mispricings. And one specific example of a stat arb strategy is actually a term structure strategy. Term structure strategies trade based on the relationship between different expirations of futures contracts for a given market. So you might be trading July corn against November corn. You're hedged against overall movements in the corn market. And finally, we have alternative data trading strategies. These strategies make trading decisions using an outside, non-price data source, and the idea is to profit from superior information that others don't have. So by this point, we had looked at many different trading strategies, but we hadn't discussed how to evaluate these trading strategies. And first of all, the goal of any trading strategy is to maximize the risk-adjusted returns. And that's what the performance metrics are for. They paint the picture of what the risk-adjusted returns look like. The Sharpe ratio and the Sortino ratio measure returns per unit of volatility, with the Sharpe ratio looking at the overall volatility, the Sortino ratio looking just at the volatility of negative returns, the downside deviation. Max drawdown and expected shortfall measure the worst case scenario risk. They're both looking at the far left tail of the returns distribution, the negative tail. Alpha and beta, we use those in order to measure the returns in excess of the stock market, So what fraction of the returns are coming from the strategy alone, and what fraction of returns are just coming from the stock market. Win rate and risk-reward ratio describe the shape of the returns distribution. How often do I win? When I do win, how much money do I make? And when I lose, how much money do I lose? And finally, we concluded with a proof that for futures trading with uncompounded returns, the mean of annual returns minus the risk-free rate divided by the standard deviation of annual returns, this being the classical Sharpe ratio formula, is equivalent to the square root of 252 times the mean of the daily strategy P&L divided by the standard deviation of the daily strategy P&L. And the point of going through this proof is that it really simplifies the backtesting process. We don't need to specify a capital amount K in order to compute the returns. We can simply use the P&L. We don't have to look up the risk-free rate. We don't have to worry about dealing with annual figures. We can deal with daily figures. So all you have to do is compute the daily strategy P&L, take the mean, divide by the standard deviation, multiply by the square root of 252, and you have your Sharpe ratio. Next up is overfitting, the most common backtest mistake. Our definition of overfitting was identifying a false pattern through the repeated analysis of counterfactuals via parameter tweaking, introducing hindsight bias. Overfitting is a form of p-hacking. It's rampant throughout finance and even throughout academia because of publication bias. Overfitting is a very big problem, but there are ways to avoid it. We discussed 3 such methods. One of them is parameter diversification. Trade many different parameter sets to minimize the idiosyncratic risk associated with any individual parameter set. We also want to look for parameter stability. That means looking for smoothness of the cross-sectional performance metrics. We want them to be gradually increasing to a peak, then gradually decreasing thereafter. And finally, the most surefire way to avoid overfitting is to do out-of-sample testing. This means using a rolling window to train on the prior 10 years, the in-sample period, and then test on the current year, the out-of-sample period. And you do this for every year throughout the backtest. When we're analyzing how a strategy performs over a backtest, we're not concerned at all about the in-sample period. We're only looking at the performance over the out-of-sample period. And finally, backtesting is a tool to reject a strategy, not to accept one. Even if the backtest is truthfully telling you that a strategy did amazing over the past, that doesn't guarantee that the strategy will work today or that it will continue to work in the future. This could be because of a regime change, a publication, or just general increasing market efficiency. So while you can use a backtest to reject a strategy, and that if it didn't make money in the past, we're not going to trade it, it's probably not going to make money in the future, we can't just blindly accept a strategy because it did well in the backtest. Then we did the 2 videos on optimization, beginning with parameter optimization using machine learning techniques. What is machine learning? We're going to define it in just one sentence here. It's when you're trying to learn the function f to map dataset x into dataset y using a machine learning algorithm with hyperparameters h1 to hn by minimizing the loss function L of h1 to hn. So one more time, the objective of hyperparameter optimization, choose h1 to hn to minimize L of h1 to hn. And for trading parameter optimization, you want to choose trading parameters t1 to tn in order to maximize the Sharpe function, S of t1 to tn. We can express both these optimizations as equivalent problems, and therefore they will have an equivalent solution. There's 3 different searches we discussed about searching for the optimal parameter set. The grid search, where we test every parameter set in the entire parameter space. We'll do this if it's a simple strategy or a small parameter space. The random search, which we'll do when the grid search is not feasible. This is a grid search over a random subspace of the parameter space. We'll do this if it's a complex strategy or a large parameter space. And finally, the Bayesian search. This is when we're adaptively selecting parameter sets using past results. It is the most efficient search. The problem is it's difficult to parallelize. So sometimes you'll do a parallelized random search in order to shrink down the parameter space, and then you'll apply a Bayesian search to that shrunken down parameter space. The other kind of optimization we discussed is portfolio optimization. This is about allocating weight to parameter sets in order to form the strategy portfolio. And the goal of portfolio optimization is to choose weights W1, Wn in order to maximize the out-of-sample Sharpe ratio. Maximize the Sharpe ratio of the weighted linear combination of the return series over the testing period. But we don't want to allocate weight to every single parameter set, only to parameter sets that have high training Sharpes. That's because statistically, the Sharpe ratio is the t-statistic of the hypothesis test that the expected return is positive. So you want to keep parameter sets with high training Sharpes because we have more confidence that those parameter sets will make money in the future. Now, there is a theoretical solution to this optimization problem from Nobel Prize winner Harry Markowitz. Unfortunately, it's not practical because it relies upon an accurate forecast of expected returns, and returns are almost impossible to accurately forecast. So instead, we adopt a risk parity approach. This is where we allocate an equal amount of risk to each parameter set. Mathematically, we do that by choosing W1 to Wn to minimize the sum of squared differences of the risk contributions of different parameter sets. We want each parameter set to have the same risk contribution, meaning they all contribute equally to the overall portfolio volatility. We start with the risk parity weights, but we do sometimes adjust those based on liquidity. If we have strongly correlated markets, we're going to shift weights to the more liquid market. This will decrease our transaction costs, but it's not really going to have an impact on our risk. And finally, when we're allocating weight to strategies to form our overall portfolio, this process is more discretionary than systematic. We're using many different factors. We do start out with the risk parity weights, but then we'll adjust them based on things like the out-of-sample Sharpe ratio, the strategy's capacity, and the live trading performance of the strategy. Our next topic was risk management and position sizing. First, position sizing. So we manage to a target annual volatility V, and we choose our position size Ni in order to achieve that target volatility. We do that via the formula Ni equals S times Wi times V times K times M, all divided by the square root of 252 times sigma. And once we compute Ni for every parameter set, we're going to sum the number of contracts for parameter sets that fire, meaning they give a buy or sell signal rather than a no trade signal. On the risk management end, we apply scaling to decrease our position sizes when risk is high and increase our position sizes when risk is low. We do this by running linear regressions using our current positions, the VIX, and the previous month's volatility in order to predict the daily returns magnitude sigma hat. From there, we can compute our scaling multiplier, M equals V over the square root of 252 times sigma hat, and we'll multiply our positions by the scaling multiplier in order to increase them or decreasing them depending on the risk. M has expectation 1. That means in aggregate, scaling is neither decreasing nor increasing our position sizes. It is only increasing and decreasing our position sizes at certain times, just as we want. And we'll bound M to be between 1/5 and 5. But a value of M as extreme as 1/5 or 5 is very rare. Most of the time, M is close to 1. And the desired goal of scaling is to push the tails of the returns distribution toward the center. So by decreasing our position sizes when risk is high, we're cutting down on those extreme returns. And so while scaling isn't going to have a big effect on our Sharpe ratio, it should have a positive effect on our max drawdown and our expected shortfall. Next up is execution, the order entry strategy for getting orders filled at the best price, for minimizing our transaction costs. There are two fundamental order types out there, the market order and the limit order. Market orders are orders to buy or sell immediately. We almost never use market orders because they entail crossing the bid-ask spread and incurring greater slippage. And the other order type is the limit order, an order to buy or sell at no worse than the limit price. We always use limit orders, but we use them along with an algorithm. One such algorithm is the pegged limit order algorithm. And this is when, if we're buying, we'll keep a buy limit order on the best bid. If we're selling, we'll keep a sell limit order on the best ask. And the idea of this algorithm is we don't want to cross the bid-ask spread and incur that slippage. Instead, we want to wait for them to come to us and for other traders to cross the bid-ask spread. But we still want to have a timely fill. So that's why we always stay on the best bid or the best ask. Next up is an iceberg order. This is another algorithm in which you're showing only a fraction of the size you want to trade. Once that fraction's filled, you show more, and you continue this process until everything is filled. You don't want to show all your size right away necessarily, because it could cause the market to move before you get filled. And combining these two, we have our final execution algorithm, which is the pegged iceberg order. These are limit orders pegged to the best bid when buying and the best ask when selling, showing only up to 10% of the bid size or the ask size in the spirit of an iceberg order. So we're pegged to the best bid and best ask to ensure a timely fill without crossing the spread. And we use iceberg orders so that we don't cause the market to move before we get filled. And finally, our last topic was the technology we use to trade. We discussed two programming languages, Python and C++, with Python being our go-to due to its syntactic simplicity, its versatility in being able to solve a variety of different tasks, and C++ being our language of choice when speed was of the utmost importance. So we use C++ to program our execution algorithm. We use Python to program everything else. And one other benefit of Python is it has many different professional libraries to aid in computation. Two such libraries are Pandas and NumPy. These are the industry standard data structures and data analysis libraries with vectorized operations that really speed everything up. HyperOpt is a library for machine learning hyperparameter optimization, but we repurpose it to do trading parameter optimization. And we talked about a lot of other stats libraries as well, such as SciPy.optimize, scikit-learn, stats models, and PyFinance. We concluded by discussing the specific trading platforms and brokerages we use to place our trades. Sierra Chart is a trading platform with a C++ API. We use this for automated trading for the hedge fund and for my personal account. Then Interactive Brokers Trader Workstation. The brokerage and trading platform has built-in execution algorithm and great support for managed accounts, and we do use them for our managed accounts. So that's the last of the recaps for each presentation. We've made it to the end. This will be the final slide. We've come a long way from what is the future and what is quant trading, through the entire backtesting process and optimization, all the way to dynamic risk management and execution. And this process has been almost entirely systematic. Discretion has only been used at the very beginning and at the very end, in creating the trading rules for this strategy and in allocating weight to those strategies. And because there is no systematic solution, these are the problems that are the most difficult for a modern-day quant trader. Finally, I'll end on a philosophical note. Quant trading is all about predicting the future, and it's not about modeling the past. It will be very tempting to make your strategy look amazing on past data by overfitting. But if you do that, you're not going to make money trading. You'll just be living in a bubble. So break out of that bubble, see the world for how it is, not how you want it to be, and that's how you'll make money trading. Thank you for watching my videos. I hope you learned a lot, and take care.